Welcome back to the Longacres Finance channel. First off, I'd like to wish everyone a happy new year and a very fruitful year in your investing journey. With the start of a fresh new year, I have made a few small tweaks to my high-yield dividend stock watchlist, and I'll talk about those changes shortly. But first, let's take a look at my 10 best high-yield dividend stocks for the month of January. They are Toronto-Dominion, Amgen, MT Bank, Morgan Stanley, Lockheed Martin, Ben Franklin, ViacomCBS, Philip Morris, 3M, and Best Buy. A good mix of familiar names that you may have seen in the past if you follow my monthly high-yield dividend stock updates, and a few new names to broaden our scope. Collectively, these 10 high-yield stocks offer an average dividend yield of 3.42%, with Philip Morris having the highest individual yield of 5.3%. Based on dividend yield theory, all of these companies with the exception of Toronto-Dominion appear to be undervalued right now. The average payout ratio hovers around a very nice 45%. The 5-year trailing dividend growth rate is a respectable 11.3%. And most importantly, all 10 companies have a streak of long-term revenue and earnings growth. We will take a closer look at each of these 10 companies, but first I'd like to get back to the changes to the watchlist. The main change was a modification of the ranking system. I've simplified the previous ranking system to focus on only 6 metrics now. The scoring system gives preference to companies with a wide economic moat, a strong management team, a low payout ratio, a high dividend growth rate, potentially undervalued companies, and the current dividend yield. Each month I use a screener that I have designed in my Schwab brokerage account to pull a list of high-yield dividend stocks that meet all of my minimum criteria. This month a total of 28 companies were included on the list. I then rank all of these companies based on the 6 metrics I just mentioned, and I sort the list in descending order. Then I compute an estimated long-term rate of return for each stock using the current valuation and analyst forecasted earnings. And I select the top 10 highest ranked companies that have an estimated long-term rate of return of at least 12%. To be included in the current month's watchlist. A 12% annual rate of return is my personal long-term return target. While I prefer to invest in fairly valued or undervalued quality companies, I am also willing to pay a premium for a stock if I think it can deliver a strong long-term rate of return. There are no guarantees in the market, and no quantitative model that can accurately predict which stocks will be the winners all of the time. And because of this, I expect that my process will be wrong at least some of the time. And I am content with this. Because I also believe that collectively, the 10 chosen high-yield stocks should deliver strong long-term growth for my portfolio. I also believe that the screening process helps me narrow down on higher quality companies that are more likely to offer growth in the future and less likely to lose my money. The watchlist has 14 months of historical returns now, and it has performed slightly better than VYM and slightly worse than SPY. The total return for the watchlist over the past 14 months is 47.07%. VYM is up 46.51% during this time, and SPY is up 48.06%. The December 2021 watchlist performed very well, picking up 7.61% last month. This was 0.87% better than VYM, and 2.99% better than SPY. The final 2021 return for the watchlist clocks in at 26.31%, which is a very solid year in my book. The annualized rate of return is 39.18%. Which means I have started out with a very big cushion above my target 12% annual rate of return. Going back to the December watchlist, the best performing stock was Atmos Energy that tacked down an even 16% in December. Amgen was the second best stock with a 13.12% gain. In third place we had Philip Morris with a 12.03% gain. Restaurant Brands gained 9.3%. Darden was not too far behind with a gain of 9.2%. Then there was a gap between the next best stock, which was Principal Financial Group with a gain of 5.47%. MT Bank gained 4.75%. 3M gained 4.46%. And Morgan Stanley picked up 3.52%. The final stock on the December watchlist was ViacomCBS that lost 1.7% last month. Like I stated earlier, it's really hard to only pick winners. But I'm content with how the watchlist performed overall. It's hard to complain when you generate alpha over your benchmark and outpace the broad US equity market to boot. Okay, let's dig into the January watchlist now. First up, we have Toronto-Dominion Bank with a healthy 3.65% dividend yield. Of course, as a US investor, anytime I invest in a foreign dividend stock, I am subject to foreign exchange rates. This means that the dividend income paid by Toronto-Dominion may not be consistent, but for me that is fine. The bank pays a high enough dividend yield that even with the fluctuations in exchange rates, I am happy with the dividend income generated from this position. The stock appears to be about 6% overvalued right now, based on dividend yield theory. But even with this slight overvaluation, I am forecasting a long-term total return of 14%. Based on this assumption, to me, now is a good time to add to this position. The company has a healthy payout ratio of about 41%. and a decent 5-year dividend growth rate of nearly 8%. Top-line revenue for the bank has grown at slightly more than 2% per year during the last 5 years, and bottom-line earnings have grown at a faster rate of about 10.5% per year. Based on these factors, I can safely assume that the company can continue to grow its dividend in the future, and is likely to generate a healthy return on my investment. The stock gained 6.41% in December, and is up over 80% since it initially joined the watchlist in November of 2020. This makes them one of the best performing stocks this watchlist has produced, with an average return of 4.3% per month during the last 14 months. Next up, we have Amgen, that also sports a pretty attractive dividend yield of 3.43%. Dividend yield theory suggests the stock is about 29% undervalued right now, with the long-term forecasted total return just shy of 16%, providing a little cushion to my 12% target. The company has a rather high payout ratio of about 89%, but it has also increased its dividend at a very fast rate of 15.16% during the last 5 years. This is a very fast growth rate for such a high-yielding stock. Dividend growth has far outpaced top-line revenue growth and bottom-line earnings growth. With a high payout ratio and a lower earnings growth rate, I think that dividend growth for Amgen will be lower in the future than it has been historically. The stock had a very strong return in December of 13.12%, but has not performed too well since joining the watchlist in November of 2020 with the 7.63% total return. This equates to just 0.53% per month, which is about 5 times worse than the average watchlist stock return. Nevertheless, I have a sizable position in Amgen, and I have continued to add to this position with the long-term outlook. Up next, we have MT Bank with a good 3.13% dividend yield. Dividend yield theory suggests the stock is about 31.5% undervalued right now. My return forecast is estimating a high 24.62% long-term rate of return for the company, giving me quite a bit of margin of safety. MT Bank has a very low payout ratio of about 32%, with a good 5-year dividend growth rate of 9.46%. Revenue and earnings have good long-term growth rates in the 6 to 7% range. The stock returned 4.75% in December, and is up 54.16% since joining the watchlist in November of 2020. That's a 3.14% monthly rate of return, making MT Bank one of the better watchlist stocks. Up next, we have Morgan Stanley with a good 2.83% dividend yield. The stock pops on and off the watchlist as its dividend yield is pretty close to the minimum threshold of 2.75%. Dividend yield theory suggests the stock is about 32% undervalued right now. I am forecasting a solid 17.39% long-term rate of return for the stock. The company has a very low payout ratio of about 22%, and a very strong 5-year dividend growth rate of 20.55%. Morgan Stanley is hands down the best stock on this month's watchlist in terms of payout ratio and 5-year dividend growth. The stock returned a modest 3.52% in December, and is up only 2.96% since joining the watchlist in August of 2021. This makes Morgan Stanley slightly better than Amgen, but still grossly underwhelming compared to the average watchlist stock, with only a 0.59% average monthly return. Up next, we have Lockheed Martin with a good 3.17% dividend yield. Based on dividend yield theory, the stock appears to be about 20% undervalued right now. I am forecasting a long-term return of 12.24% for the stock, which doesn't leave much margin of safety above my target. But since the forecast is above 12%, the stock looks attractive to me. Lockheed has a healthy payout ratio of about 49%, and a good 5-year dividend growth rate of 9.77%. Revenue and earnings have also grown at double-digit rates during the last 5 years. All these factors point to a very solid and growing business. Lockheed gained 6.63% in December, but is up only 5.35% since joining the watchlist in November of 2020. This equates to a rather low 0.37% monthly return. I personally have a long-term outlook, and the short-term lackluster performance doesn't bother me, so long as the forward-looking assumptions make sense. Up next, we have Ben Franklin, that is appearing on the watchlist for the very first time. This dividend aristocrat sports a solid 3.43% dividend yield, and appears to be about 1% undervalued based on dividend yield theory. My long-term return forecast is pointing to a 14.34% rate of growth for the stock. The company has a very low payout ratio of about 33%, and a good 5-year dividend growth rate of 9.98%. Revenue and earnings have grown at a modest range of 4 to 5% annually during the last 5 years. I'm excited to have this dividend aristocrat join the watchlist, and I look forward to seeing what returns it can offer. Up next, we have ViacomCBS with a good 3.08% dividend yield. Dividend yield theory suggests the stock is about 89% undervalued. The reason for this high potential undervaluation is the significant price decline of the stock during 2021. Viacom started the year with very strong returns, but quickly shed all of those gains during the latter part of the year. I like the stock at this current valuation, although I don't actually believe it is 89% undervalued. My long-term return forecast is showing a 32.45% annual growth rate for the company. This forecast is greatly influenced by the undervaluation and therefore may be overstated as well. The company has a very low payout ratio of about 20% and a good 5-year dividend growth rate of 9.86%. Revenue and earnings have also increased during the past 5 years, and to me the stock makes sense for a long-term investment. Viacom had a rather poor return in December, losing 1.7%. This marks 4 consecutive months of negative returns for the stock. The stock joined the watchlist in November of 2020 and is up 8.76% since then, making it one of the worst performing watchlist stocks. Up next we have Philip Morris with a very nice 5.3% dividend yield. Dividend yield theory suggests the stock may be 1% undervalued right now. My long-term return forecast for the company is 16.6%. The company has a high payout ratio of about 85% and a rather low 5-year dividend growth rate of 3.22%. To compensate for the lack of dividend growth, investors are rewarded with a higher starting dividend yield. Philip Morris rocked a very cool 12.03% return in December. The stock is up 19.04% since joining the watchlist in March of 2021. This equates to a 1.76% monthly return, which is below the watchlist average. Up next we have 3M Company with a good 3.33% dividend yield. Dividend yield theory suggests the stock may be 19% undervalued right now. My long-term return forecast for the company is 15.46%, and a good dividend growth rate of 7.48% during the last 5 years. The stock returned a modest 4.46% in December and is up 15.57% since November of 2020. This equates to a 1.04% monthly rate of return. This is actually more than adequate for my expectations. You may think that I would need to earn at least 1% per month to have a 12% annual return, but you'd be wrong. Because of compounding, I actually only need a 0.95% monthly return to hit my 12% annual target. The final company on this month's watchlist is Best Buy, that is also appearing here for the very first time. The stock offers a 2.76% dividend yield, that is just high enough to make the list. Dividend yield theory suggests the stock may be about 20% undervalued right now. My long-term return forecast for the company is 16.65%. The company has a very low payout ratio of about 25%, and a very high 5-year dividend growth rate of 19.56%. This is a very good payout ratio and dividend growth rate combination for a high-yielding stock, just slightly worse than Morgan Stanley. There you have it, the 10 best high-yield dividend stocks on my watchlist for January of 2022. Of course, I advise you to do your own research before you make any investment decisions. Before I wrap up here, let's take a quick look at the best performing stocks from past watchlists. The average monthly return for all 50 stocks that have crossed the watchlist at some point during the past 14 months is 2.55%. The best monthly return as of right now goes to Atmos Energy with 16%. However, this is a little unfair, seeing how Atmos has only been on the watchlist for 1 month. The second highest average monthly return is 5.11% from Broadcom over an 8-month period. And the third best monthly return is 4.93% from Principal Financial Group over a 14-month period. Principal Financial Group actually has the highest cumulative return since joining the watchlist at 93.66%. Very close to being the first watchlist stock to cross the 100% return threshold. Hopefully many more will cross this threshold in the coming months and years. I hope you enjoyed the watchlist. Thank you for watching and see you next time.